Hey folks, Shawn Plummer over at the Annuity Expert. In today's video, we're going to answer the question, why do different companies offer different annuity rates? Okay. I mean, that's kind of a loaded question. So I'm going to kind of start somewhere and then just take it other places. All right. So when I talk about how annuities are created, I use the analogy that was taught to me 18 years ago. Thanks, Scratch. That the analogy is there's only 100 pennies in a dollar. Okay. And when an actuary is kind of like a mathematician, and they go in and the marketing team at the insurance companies will say, hey, we want to create a new income product, or we want to create a new bonus product, or a new MIGA, type of deal. And they'll hire these actuaries, and what they'll do is say, okay, well, we've got these 100 pennies. How do we allocate it? And they're going to allocate it to different things like bonuses, fixed interest rates, liquidity, death benefit, minimum guarantees, commissions to the agent, commissions to the wholesaler. How long is the term? Is there a bonus vesting schedule? I mean, there's all these different bells and whistles that they put into lifetime income riders, payout percentages. I mean, it's a long laundry list of the actuaries have to solve and place those 100 pennies. Okay. So, why they're different rates? It's because that they're allocating those pennies more heavy somewhere and lacking elsewhere. So I'll give you an example. So, there's a company out there called National Western. National Western has a product out there that will give out, in certain circumstances, will pay a much higher income than other annuity companies. And the reason why is because the upside potential is garbage. Like, you might make 2% as an average rate of return, and the contract is 15 years long. So you're stuck with them for 15 years. Now, if you're taking lifetime income, 15 years may not be a bad thing, right? Because you're going to be taking a income for the rest of your life. But you're not going to get much upside. You might get a bonus, but the bonus isn't going to scratch the surface over a long period of time. So those are the type of, that's an example of why that they have those different rates. Now, this is important. So listen up. 18 years I've been doing this. I haven't seen this happen often, but sometimes insurance companies overprice their products. So if there's 100 pennies, they may put 120 pennies into that product, and that's 20 pennies too much, and they end up having to stop selling the product or sometimes go out of business. And this is important to understand. I'm going to give you an example. In the early 2010s, when I used to work for Allianz, their actuaries came down, they saw us face to face, and they asked their marketing guys, hey, we want to create a new annuity. What annuity should we create? And we said, well, we have an issue with this company called Security Benefit. I think they were like a low B, maybe a C rated insurance company that got back into the annuity game, and they came out the gates fierce. I mean, they had this secure income annuity that would destroy every single other insurance company. I mean, we're talking 90+% of the time, you couldn't beat the income payouts that the CEO was offering through Security Benefit. Well, guess what? About 5-6 years later, they had to stop the selling of that annuity all of a sudden because they found out they overpriced the annuity. And I don't know what happened behind the scenes, but I'm sure they went through a struggle because they overpromised. Now, did they underdeliver? I haven't heard any nightmare stories yet, but I'm sure that they paid a pretty penny to make up for those promises. The good news is they got enough business, enough money coming in that they went from like a low, maybe a C, low B rated company to an A- rating. Okay, so they did something right? And now they're a player in the annuity game. Okay, now then you look at a small company like Colorado Bankers Life. They're in receivership. They came out the gates with a MIGA, and now they're barely in business, if not in business at all. Okay. Same thing with Genworth. Genworth's out of business because they overpriced their annuities and they couldn't get any traction and they couldn't get their financial ratings together. Okay. There's a couple of companies now, Atlantic Coast Life and Sentinel Security, their sister companies. They're looking for a new buyer right now as of May 2026. They're having a tough time, keeping afloat. They're having a tough time getting their shit together. That's just what it is. And that a lot of the times it's because that they don't price their products. They focus more on being competitive, better than everybody else to get business and then fix the problem later. And rather than trying to fix their financials first and just staying in the pack with annuity products, right? Instead, they want to come out super, super duper strong and they end up screwing up and they have financial troubles, okay? There's new players in the MIGA game. Canvas Annuity, 13 employees. That's it. That's the whole company. 13 employees. And not all of them are financial professionals. Like there might be 6 of them that are financial professionals. So you're putting your hands in a teeny tiny company that's owned by a company called Puritan Life, that's B-rated and has been around since the 50s and still can't get an A- or better rating. That's a problem. Gamebridge, small company, direct to consumer, tiny company owned by Group 1001. 12 years maybe they've been around. Okay. Then there's other ones, American Gulf. And then there's other companies like Exonic and Ocean View that have been around for less than 10 years, but they have an A- or better rating. They are doing something right to get an A rating, right? So I would tell you with caution that it is rare for an insurance. It is really rare for a major insurance company to go bankrupt. It's really rare. But it does happen to smaller companies. And companies do overprice their products because they're trying to get as much capital coming into their company as quickly as possible, and then they'll fix the problem later. So it's your money that's going into an annuity company. Is it worth the risk to go with a teeny tiny company with less than 100 employees offering a skyrocketing interest rate and gambling whether that they're going to be in business in the next 5 years, or taking a normal interest rate with a company like a North American or a Midland that have been around for like 75, 100 plus years, or Lincoln Financial, right? A company that's been around that has an A rating, right? So you got to think about these things. Annuity companies are not invincible. And like banks and credit unions, by the way, there have been way more banks and credit unions that have closed down than insurance companies, which is surprising. Maybe not surprising, but you should know that, right? But insurance companies, annuity companies they're not invincible. And they're going to know that if you're buying an annuity and the income is extremely high, like the National Western example that I gave you, whether you buy an annuity through us or through somebody else, you got to ask the question, and it's on you. It's nobody else's fault. It is you, the buyer's responsibility. Why is this annuity paying so much higher than every other annuity out there? I've gotten 2 or 3 quotes. This one destroys every other annuity. Well, it's easy. It's a 15-year long commitment, and you're not going to get crap for upside potential. Okay. I can live with that. I can live with a 20% increase in income compared to everybody else for the rest of my life and not get any interest because it's just garbage. And I'm taking an income for the rest of my life. So 15 years isn't that big of a deal because I'm going to be collecting a paycheck until I die. It may be 20, 30, 40 years in the future, right? So it's important to know that there are cons. If you get a bell and whistle that you like, you are giving up something somewhere else. And if the person that is selling you the annuity cannot tell you that to your face off the cuff, you need to be looking elsewhere for your annuity purchase. because it's more important to know the cons of the annuity contract than it is the pros. Okay. So that is why different companies offer different annuity rates from each other. If you got any questions about that, leave a comment below. I'd be more than happy to answer it. If you want to do it privately, contact us at the Annuity Expert. We will provide that to you, no cost, no obligation, and we'll give you the advice that you need to be making. Like, subscribe, and we'll catch you on the next video. See ya.